of notes in their local markets. So due to this medium-term loans, whose life is between 1 to 3 years, so they require loan, special kind of loans called term loans, in which there are terms and conditions in which every year you not only pay interest but also principal, right? So that the default risk is going to be reduced, right? So loan of year or longer extended by the banks to MNCs or the government agencies in Europe are commonly called Euro credit loans or Euro credits. So now we have one more term or one more jargon of international finance, that is Euro credit loans, which are issued for medium term, 1 to 3 years, right? So remember, and these loans are issued in Europe. Of course, what we call that, the dollars that are outside United States, we call them euro dollar. So if a bank needs, if a company needs dollars and they are asking loan from European countries, we call them euro dollar loan. But if for 1 and 3 years medium term loan, then we call it euro credit loans or euro credits. So to avoid interest rate risk, banks commonly use floating interest rate. So what is interest rate risk? The risk that the interest rate may rise between the period. So, but if I am the bank, I give you loan, I am fixing my risk, right? What about that? What happened to after 2 years or 3 years, maybe interest rate rises, so I lose my opportunity to earn more. As a banker, I lose my opportunity to earn more interest rate because interest rates are high. So they negotiate with the MNCs or government agencies that we will be charging floating interest rate, which means if interest rates are higher, we will be charging you higher interest rate. If interest rates are lower, we will be charging you lower interest rate, right? So how they are doing it? So they tie their interest rate with LIBOR, London Interbank Offer Rates. So which basically, it is established or it is, published every day, every hour, every 3 months. They started their projections. If you go to their websites, it's already this. So every interest rate ultimately linked to LIBOR, London Interbank Offer Rate. So if LIBOR increased, your interest payments increase. If your LIBOR decrease, your interest payments decrease. Now, regulation in credit markets. Number 1, Single European Act. So when Single European Act passed, in which all the countries only adapt 1 euro currency, right? So it means capital can flow freely throughout the Europe, from Greece to Cyprus to Italy, right? Easily. So banks can offer a wide variety of lending, leasing, and activities in Europe. So that's increase the credit, enhancement for the EU or European countries, and also for other countries as well, those who are not the part of Europe, right? Because money tend to flow where interest rates are higher. So regulations regarding competition, mergers, taxes are similar throughout the Europe, because they have already passed the Single European Act. So a bank established in any one of the European countries has the right to expand into any or all other European countries. So when this regulation passed, what happened? Now you have more opportunity to lend to other countries in Europe, to lease asking for leads to whoever is giving you best leads. Consumer will go to that. Plus, a bank in Greece can open its branch in other banks, Spain, right? In Cyprus, in other parts of the European countries. Number two, Basel Accord agreement. So Basel Accord is basically it is enforced. Just going to give you a, because we have more whole subject or course on this Basel Accord in our advanced classes. So I'm just going to give you a small, explanation of Basel so that you can digest here. So Basel is basically established. Why? Because we know that the balance sheet equation is assets is equal to liabilities plus owner's equity. But in case of banks, owner equity is very small, 1%. Why is that? Because banks run through deposits, and who are the depositors? The general public. General public deposit their money with the banks. For bank, it is liability, right? So what happened after 2008? Correct, the financial crisis and all the stuff. The industry, there are the run on the bank. People lose a lot of money because this 99% of the banks, how they generate money, they lend their liabilities to customers and charge interest. For example, they charge 15% from interest, from their customers as to MNCs or other in which they have already given them the loan, and they pay to their depositors only, for example, 5%. So 10% they keep in their pockets as a spread. So what happened? This encourages the banks to a phenomena we call that financial greed. Financial greed. So they were offering different kinds of credit. So credit card, leasing loans, house financing loans, equity market loans, for share purchasing loans, for anything you want to buy, you can buy on loans. So what happened when default started? The depositors start losing their money. So banks owner only invested 1%. So who is at the risk? In banks, depositors. So in order to decrease the risk of depositors, the Basel Accord agreement or Basel Accord principles, they are established, and they say that if you want to register or you want to open a bank, at least you need to hold your equity 4%. Previously, the banks are even 0.1% of their equity, which means 99.9% they are running on liabilities. Because for banks, the money doesn't belong to them, money belongs to the depositors. So for banks, these are their liability and they need to repay that. So the Basel Accord agreement say that you cannot open the bank unless you have 4% of the equity, which means 96% deposits are required to open a bank, which is still, from 0.1% to 4% is a huge jump. Nowadays, banks' total assets are in billions or in trillions, right? So let's move forward. Syndicated loans in credit market. Sometimes a loan is too big. Normally, government agencies or big MNCs, they require sometimes loans of $10 billion. So if one bank gives this loan, $10 billion to a company or a government, its risk is higher, because if that government defaults, like Sri Lanka, their money will be gone, or they will be experiencing huge losses. What if the company is default or liquidated or whatsoever? So their risk is high. So what they do, they ask from different banks, for example, HSBC, ICBC, Scotland Bank, Royal Scotland Bank, RSP, or others, HBL, to satisfy or to grant these loan to one company or one government. Government needs funds, okay? For example, they are building bridge or making dams, making roads, infrastructure. They need big, big loans. So by doing this one, every bank is basically reducing their, loan risk, plus the government or MNC can obtain large funds. So a syndicate of the banks can form to underwrite the loans, and leading bank is responsible for negotiating the terms with the borrower. So though that bank which provide highest loan, for example, in 10 billion, one bank is providing 5 billion, others are providing only 1 billion and 2 billion. So in that case, it is totally equal to 10 billion. So who will be the leading bank? This bank. And this bank will be negotiating. So bank here, for example, HBL, RBS, Royal Bank of Scotland, we have HSBC, and we have Bank of China, BOC, and we have ICBC. So ICBC on behalf of all those, HBL, RBS, HSBC, BOC, it will go to the MNC or the government and negotiate on their behalf. So when you will be paying us the interest and principal, and how that interest and principal going to be distributed among all these 5 banks, right? So this becomes syndicate because they gather a pool of funds and to satisfy a $10 billion loan. So guys, you understand, Tiffany? Oliver?
Yes.
Sufyan? EGA? Good.
Yes, sir. Yes,
Yes.
sir.
Ruchie? Dion?
Yes.
Yes.
Okay, good. Now, what happened if there is a credit crisis? So what happened to the credit market in which medium-term loans are issued? So we have example here. The credit crisis of 2008 triggered by the defaults in subprime loans led to a halt in the housing development, which reduces income and spending and jobs. So everything is linked together. So financial institutions became cautious with their funds and were less willing to lend funds to MNC. Although the 2008 crisis is because of subprime mortgage default of only one sector of housing industry that collapsed, right? And it triggered chain reaction to the economy, right?